In this video, I want to show you why just one daily candle is what you need to become successful forex trader. You only need one daily candle to become a very profitable and successful forex trader. After this video, your trading career will change for the better. Your trading career will change. You would become better and profitable. You win more trades and you achieve the success that you have been looking for. This is in fact an upgrade of the previous video I've made on one daily candle is just enough. One daily candle is just what you need. And after that video, I got a lot of questions from you and I'll be answering all of your questions in this video. This is an upgrade of the previous video, so do not fail to view this video from beginning to the end. Towards the end of this video, I'm going to answer all the questions that you have on this strategy. Even from the beginning to the end of this video, I'll be answering all your questions and I will also give you more ideas on how you can trade this strategy profitably. All right, I'm going to answer all your questions and show you a better way and a more reliable way of trading this strategy. You need to know how to mark your candle. All right, you need to know how to identify the high, the close, the open and the low. This is your bullish candle and this is your bearish candle. For a bullish candle, the candle opens right here, the candle opens right there. All right, after it opens, it makes the low of the day. All right, this is the daily candle. All right, this is D1, this is your daily candle D1. All right, so for a bullish candle, it opens here, makes the low of the day right there, trades down, then trades up and then makes its high and then closes right there. All right, for a bullish candle, this means that the buyers are in control, and this is the candle range. This is the candle range. I've made a previous video on candle range theory. Kindly view that video, is on the description box of this video, or just go to the history section of my YouTube channel. You're going to see candle range theory, more explanation on that. All right, so now for a bearish candle, the candle opens right there and makes it high here, trades up to make its high here, high, then trades down to the low, makes its daily low, and then closes right there. So in this candle, in this daily candle here, it shows that the sellers are in control. The bullish candle, the buyers are in control. So also it obeys the principle of the accumulation, the AMD principle, which means accumulation, manipulation and distribution. Now the retail traders would accumulate orders right there at the market open, which you can see here, and now this is the A, accumulation phase. Institutional traders will trade down, all right, in a false move in order to lure retail traders to take a sell trade, and this is called the manipulative phase. So they manipulate retail traders to take a trade in this direction, which is now formed the low of the day here. So but they have the intention of distributing the market, going in opposite direction. When they go in opposite direction, they'll now take out all stop losses placed right there, and this is called a distribution, the AMD distribution. And when the market has distributed, the market will now close right there. For the bearish scenario, you have the market opens there, all right, with accumulation, and then trades up. Okay, this accumulation trades up from the high of the day. In a manipulative move, market manipulates up M, and then it will distribute right there. All right, this is the manipulative phase. The market will now distribute before it forms the low of the day and now close. All right, now close right there. So let me show you in a better way. So you can see here, for a bullish scenario, the market orders accumulated, and then this A. I'm just trying to explain this to you because I've made a separate video on AMD. I've made 2 videos on AMD. I've made a video on daily AMD and weekly AMD. Daily accumulation, manipulation and distribution, and weekly accumulation, manipulation and distribution. Taking my time to show you all these things so that you would know what you are doing. It will expound your knowledge on this. I could have as well skipped this session, but I just want you to form a basis so that you understand the candle range theory, because this is the daily candle theory that will help you to know how market makers manipulate the market. So this is the manipulative move right there, and this is the distribution, and then the market closes right there. So you can see the candle here. This is the market open, this is the low of the day. All right, this is the low of the day, this is the distributive phase, and then market to form its high, right? The market will form its high here and then closes right there. This is for a bullish scenario. All right, this is bullish AMD. For a bearish AMD, you find that the reverse is the case. The reverse is the case. The market will open with an accumulation right there, manipulates up, and now the market will now distribute. All right, and the market will now close right there. This is the market open. This is the high of the day. All right, this is accumulation, and this is here is the high of the day created here by this manipulative move, and now this is distribution. This is the low of the day created, and before you have the close of the day. More detail about this strategy, kindly go about this AMD, kindly go to my previous video, the daily candle close strategy. Now this strategy is based on taking trades from the intersection of the previous day's candle close and the current day's candle wick or shadow, or just slightly beyond, but not beyond the previous day's high for a bearish scenario, or the previous day's low for a bullish scenario. Take your time. I've written this so that you can take your time to understand it, but notwithstanding, I'm going to show you right now how this works on the chart. All right, so for here, this is the bullish scenario of the strategy. Okay, I appreciate you for showing me love, giving the videos thumbs up, commenting on my video, sharing it. Okay, that is why I'm doing this upgraded version, so that to show appreciation and to answer all of your questions about this strategy. Okay, so in like manner, kindly share this video, subscribe to this YouTube channel if you're yet to do so, subscribe to this YouTube channel if you're yet to do so, give this video a thumbs up and share our videos with your friends, and also comment down below to let me know if this video was useful, what other video you want me to create for you. All right, so you can see right here, this is the bullish scenario, this is the previous day's candle, this is the current day's candle. So, and this is the current day's high, this is the current day's high, and why this is the previous day's low. All right, this is the previous day's low, as you can see here, current day's high. So this is actually the strategy. Here this is the candle open. All right, for a bullish scenario, this is the candle low. Now this is the candle high, and this is the candle close. So we mark the candle close for a bullish scenario. We mark the candle close. So we are looking at taking trades from here, which is the intersection of the wick. This is the wick or the shadow. We want the market to pull back to this point, and then we take our trade. So let us see. So what we want to have is that the market will pull down right there. All right, we'll have our change of character, return to order block, and now we take a trade from here. For some of you that are asking about the stop loss, this is a stop loss. Stop loss will just be right at this zone, just few pips below the zone from where you took your trade. From here, it should be a demand zone. This will be a demand zone. So this is entry area. This is a demand zone created by the intersection of the wick of the current day's candle and the close of the previous day's candle. Remember, this is your daily candle. This is your D1. You can see here, this is your daily candle. Okay, so it's only on daily candle. It's on daily candle that we look for this setup on a higher time frame. Although we're going to step down to lower time frame in a while to see how this works. Okay, I'm just trying to depict this strategy for you so that you can understand fully. So your take profit will be right there. For some of you that are asking about your take profit should be at the current day's candle high. You know, your current day's candle have had a high initially before now it pulls back, right? So your final take profit should be at the high already created by the current day's candle. All right, so now let us proceed further. For a bearish scenario, we can see here, this is the strategy here. This is intersection. This is the candle close here. This is the candle close. All right, for the bearish scenario, and this is the wick. So this is intersection, and this is where we're looking to take our trades from. We're looking for the market to pull back to this point. All right, to this zone. This will actually be a supply zone. This will be a supply zone. So we're looking for market to create some sort of change of character, return to order block, or you can as well have stuff like some reversal short patterns for retail traders, like double top. All right, double top. Okay, you can as well have head and shoulders. Okay, head and shoulders. For a bullish scenario, you can have double bottom as your reversal confirmation, or you can as well have inverse head and shoulder. Okay, or triple bottom or whatever. But if for SMC traders, you know, we look for return to order block, change of character, return to order block. So you target this low previously created by the current day's candle, and your stop loss should just be a few pips above the supply zone here. All right, few pips above the supply zone right there. Okay, now you can see how I've depicted it right there. So this is what we are looking at. The market should pull back to this point, and now we enter here from after a due entry confirmation, and we trade down to this point. Now I want to show you something. So I said our entry should be around here, but sometimes the market can as well come down somewhere around here to actually give us a zone to trade from. But most times your entry should be around here, the intersection of the wick of the current day's candle and the close of the previous day's candle. That is where most over 90% of our setup, our zone will come from here. Over 90% of our zone will come from here. But sometimes you might have the zone also from around here. All right, we'll have a zone we are trading from here. Okay, but on no account should you, if by any means the market this candle come down to this point, all right, do not enter this trade. All right, because you can have the market can just retest this and continue to sell. You are targeting entering around here. This is where you are looking at. Over 90% of your setup will come from here. Sometimes it could proceed further to this point. You might have the zone around here to trade from. Okay, so but do not trade anything beyond the previous day's low. Do not enter a buy trade anything below the previous day's low. The reason is because once this low is broken, the market can have a retest of this low and continue to sell, and now sell, all right, instead of buying. So you are looking at entering. For me, I would prefer you enter here. This is has a higher probability to enter at the intersection of the current day's candle wick and the previous day's candle close. Okay, now for a bearish scenario, most of your setup should come from here. Over 90% of your setup of your supply zone should be where you are going to see your supply zone. Okay, but sometimes, which does not happen all the time, you could have your zone created around here. Okay, your zone you might see the supply zone here around here, where you now trade your trade from. But on no account should you trade a sell when this previous day's high is broken, because if this previous day's high is broken, the market could just retest and buy instead of selling. So this setup is invalidated if this previous day's high for a bearish scenario is broken, and for a bullish scenario, if this the setup is validated if this previous day's low is broken, because this could just be a retest and a sell. I just thought I should clarify that. Okay, now for the trading rules for this strategy, every strategy has a trading rule, and most of the questions that you'll be asking me. All right, for the trading rule, for the timing of the trade, you take this trade around 9 a.m. to 3 p.m. London time. This is personally when I trade, and this is when I see my setups. Okay, I trade the London time. Okay, I am in the London zone. All right, that's where I stay. So I trade London time. So this is the time I take my setup. All right, 9 a.m. to 3 p.m. London time. Okay, most of my setups are in this time, or which is equivalent of 4 a.m. to 10 a.m. New York time. So you need to actually mark your zone before the 9 a.m. London time. You need to mark the zone, because you have the pullback. The pullback comes around this time. Okay, so before this time, you should mark your zone. All right, you should mark your zone. Now, another consideration is that the entry area. So you are entering at, for this setup, the rules, you're entering at the pullback to the demand zone or supply zone created by the current intersection of the current day's week, previous day's candle close. Okay, so that is the entry area. Now for the entry method, we are looking at, the entry strategy method confirmation is smart money entry confirmation, or any of the reversal chart patterns. I've said it already. You are using SM, you're using change of character and return to order block, or return to FVG. Okay, these are our entry criteria for smart money entry, smart money strategy. All right, but for retail reversal patterns could be double top. Okay, it could be inverse, it could be head and shoulders. Okay, for a sell scenario, now for a buy scenario, you're looking at maybe double bottom or your inverse head and shoulders. Okay, so now your stop loss, you're looking at taking your stop loss, you're putting your stop loss at a few pips outside the refined zone, okay, or unrefined zone or demand zone. I've already showed you on the chart already. That's where you're looking at putting your stop loss. Stop loss should be at of the supply zone that you saw in lower time frame, or below the demand zone that you saw on lower time frame. So now let's look at our take profit. So I already showed you that for a buy scenario, the high of the current day would be my target TP, and for a sell scenario, the low of the current day should be my target TP. So you can, however, break even at 1:1 risk to reward ratio. Now let us go into the chart now to see this. Okay, let's see this clearly on the chart. Now you can see this candle. This is my current day's candle right there, and this is my current day's candle. This is my previous day's candle. I want to just show you this setup I've already played out. I just want to show you, depict it clearly so that you can understand. For this is a daily candle. Now what do? We put this line to, this is intersectional. This is the candle close for the previous day's candle. This is the candle close, okay, and this is the wick of the current day's candle. So it's actually the intersection that we are looking at. We are looking at trading from this intersection. We want the market to pull back to this point, give us the entry confirmation, and we buy this trade, okay. And this happens on a lower time frame, okay, happens on a lower time frame. Now we have marked here the zone. This is the zone we are looking at taking this trade from, and your stop loss should be around here, and your TP should be around there, okay, on a lower time frame. So now let's step to the lower time frame. I actually activated the period separator. This line is called the period separator line. So this is the previous day, and this is the current day. So to activate this period separator, all you just need to do, if you are using MT4, go to settings, then check the period separator button. All right, check this period separator. If you're using a trading view, you might want to activate your sessions, okay, sessions indicator. Now so you can see here that this is the zone I marked on my D1. This is the zone. So the market actually traded up. As the market opened, it traded up to this point, makes somehow the high, the current day's high, and now this is my zone. The market traded back into my zone. This is my 15 minutes time frame, traded back into my zone, gave me some form of entry confirmations, and returned to FVG, and now bought. I'm going to show you on a lower time, on a 5 minutes time frame right now. So this is the setup on 5 minutes time frame. I've stepped down to 5 minutes time frame. You can see here that I got my change of character right there, and now the market pulled back to this FVG, and the market now bought. So this is actually it, the market. So my stop loss could be on this refined. My stop loss could be right there, or if I want to play safe, I could actually put my stop loss just right there. Okay, this is what I call refined stop loss. Refined stop loss, and this is unrefined. Okay, this is unrefined stop loss. That is the stop loss. This here, I've refined this entry to, after using my return, exchange of character, return to order block, or return to FVG. This is my entry, okay, and this is my stop loss, and my first take profits to be around here, okay, because this is the current day. This is the current day's high at this point. This is my TP, but I can as well continue to hold the trade. I could actually use my trailing stop loss, okay, to keep on holding the trade till there. But here, when I have my 1:1, I can as well break even and take some partial profit, and now hold trade up to the current day's high before the pullback. When I say current day's high, I don't mean the current day's high of the day totally, but before the pullback, the high created by the current day before the pullback would be my target take profit, okay. But that high could as well be taken out by the trades, okay. So now let us see how this, also you can see how I've actually depicted it. Now for a bearish scenario, this is on USD card. For USD card, this is the current day's candle, this is the previous day's candle, this is the previous day's candle. So what do? I place my horizontal line to intersect the candle close. This is the candle close of the previous day's candle, and this is the wick of the current day's candle. So my setup, my zone, and my target zone should be around here. So you can see how I have marked that zone. This here is where I'm looking to take trades. Stop loss should be around here. My take profit should be around here. In fact, the market can as well continue to sell them, but this is my target, okay. Now let's see on a lower time frame, on 15 minutes time frame. You can see that this is the previous day, and this is my current day. The market have traded down and now pulled back into the zone, All right, pull back into the zone that I marked. This is the intersection of the week and the previous day's candle close. Okay, so now I look for my entry confirmation somewhere around here on lower, better on a lower time from like M5 or even M1, and this is my target take profit. I can as well continue to take profit down. I can trail my stop loss down to this point, but my initial take profit should be here. Okay, so my stop loss should be around here, but I can as well refine it further. Let us go down to M5. So you can see on M5, this is a pullback. Now on M5, I looked and I saw that there's a change of character right here. There's a change of character right there, and now there's a pullback. So you can see there's a pullback to this FVG. This is called the return to FVG. Return to FVG, and now this is my stop loss. My refined stop loss could be here, while my unrefined stop loss could be outside the zone. So few pips, unrefined stop loss could be here, while my refined stop loss could be here. And now my first take profit, TP, the low created by the current day's candle before the pullback into the zone. Now I can as well now trail my stop loss down to this point. I hope this is clear. Okay, now let me address all your questions. By the way, if you're here to subscribe to this YouTube channel, please do not fail to subscribe. Now let me address your question. The first question you have for me is that you said, if the current day's candle has no wick, what do you do? In that case, just look for a demand zone on a lower time frame below the previous day's close for a buy scenario, and a supply zone above the previous day's close, okay, for a sell scenario. Do you understand that? So if the current day's candle has no wick, just mark this. Okay, just mark this. You are looking at your setup around here. For a buy scenario, just mark around here, somewhere around here. That is where your setup will come. If even though there's no wick. If it does not have a wick, that is not a problem. Just mark the intersection of the previous day's high candle close and your current day's low or high, as the case might be. I've just showed you. Now for your question 2, you asked and you say, what if the previous day's candle is bullish and the current day's candle is bearish, or what if the previous day's candle is bearish and the current day's candle is bullish? Okay, now the answer is no trade. So this is a trend continuation setup. So ensure that the previous day's candle is the same as the current day's candle. That is it. So no trade. So you are trading both candles should be either bearish, okay, or both candles should be bullish. That does not mean that if they are not of the same candle, the setup might not work. It can actually work. If you have bullish bearish or bearish bullish, it can work. But to be on the safe side, trade same candles. Okay, that is where you have a higher probability of success. Now your third question, you say, what if price is ranging on the daily time frame? What do you do? Now this setup is a trend continuation setup, okay, and there is a higher probability. There is higher probability if the current day's candle is bullish and the previous day's candle for the past 2 days are bullish, okay. And same applies to the bearish scenario. If you want to trade a buy and the past 2 days, the previous day's candle have been bullish, is better. You have a higher probability of success. If you want to trade a sell trade, all right, and the previous day's candle for the past 2 days have been bearish, there is a higher probability that the market is going to continue bearish. Okay, so that is the answer to that question. Now for the fourth question you asked, you asked and say, what if price didn't pull back to our entry on that day? What if price did not pull back to our demand zone or supply zone on the lower time frame? Now what do? You just wait for the next day for that currency pair, or you look for another setup on another currency pair. So what I actually do is that I have my currency pairs. In the morning, I'll shake all my pairs from 8 a.m., 7 a.m., 8 a.m. in London time. I actually shake all my pairs and identify my setups. So I trade GBP, as you are aware. I trade GBP, USD, AU, EU, USD JPY, USD CAD, and sometimes gold. Those are my currency pairs. So in the morning, 8 a.m., 7 a.m. to 8 a.m., I mark my setups on those pairs. So very definitely one or more of those pairs market should return or pull back to any of those. So if market do not pull back, you don't have a setup. Now For the question 5, you said, what if price pulls back beyond the previous day's high for a sell scenario or beyond the previous day's low for a sell scenario? I've already showed you, I've already told you what you need to do. Do not trade, because there could be a retest and continuation in the opposite direction of our intended trade. Okay, do not trade if the market trades beyond the previous day's high, okay, for a sell scenario, or below the previous day's low for a buy scenario. There could be a continuation, a retest and continuation in the opposite direction of your intended trade. So do not trade that. Okay, so if you found value from this video, please do not fail to smash the like button. All right, send these videos to your friends, all right, your other traders, so that they can learn to be profitable. Also, do not fail to join our free Telegram channel. The link is in the description box of this video. If you want me to hold you by the hand and help you become a profitable forex trader in mentorship, I run a one-on-one mentorship program. I train you, identify your deficiencies, and train you, show you how the secrets behind forex trading that will help you to become profitable and a successful forex trader. It's just a mentorship program, very small consideration, very small cost. Just send me a DM. My DM contact is in my Telegram channel. So contact me and let's talk how you can join my mentorship, my one-on-one mentorship program. I have a lot of people currently from different parts of the world on my mentorship program, and I'm so happy that my mentees that have passed through that programs are doing well. So that could also be your own testimony. So till I come your way next time with another useful content, do have a wonderful day ahead. Bye.